Stocks versus bonds. It's the oldest rivalry in finance. You've heard the terms everywhere, but what really separates them? One is built for massive growth. The other is built for safety. But here's the secret. Asking which one is better is the wrong question. The real question is, which one is right for you right now? This is the One Moment Deeper Dive. Let's start with stocks, also known as equities. When you buy a stock, you are buying a tiny piece of ownership in a company. You become a part owner. If the company does well, its value grows, and so does the value of your piece. That's called a capital gain. Many companies also share their profits directly with you, the owner. That's called a dividend. The upside? Unlimited growth potential. Historically, nothing has built long-term wealth faster than the stock market. The downside? Risk. Companies can fail, and you can lose your money. Now let's talk about bonds, also known as fixed income. When you buy a bond, you are not an owner. You are a lender. You are lending money to a government or a corporation for a fixed period. In return, they promise to pay you back in full and pay you a fixed interest rate along the way, like clockwork. The upside? Safety and predictability. You know exactly what your return will be. The downside? Your return is capped. That fixed interest payment often struggles to beat inflation, meaning your money really isn't growing, it's just being preserved. So how do you choose? This is where most beginners get stuck. The answer depends on two critical factors: your time horizon, how long you can leave your money invested, and your risk tolerance, how you emotionally handle market crashes. Think of your investment journey as a long road trip. Stocks are your accelerator. They give you the speed and power to grow your wealth and reach your goal faster. Bonds are your brakes. They provide safety, control, and ensure you don't crash when the road gets rough and uncertain. If you are young and saving for retirement 30 years away, your time horizon is long. You can afford the risk. You need that accelerator. Your portfolio will be mostly stocks. But if you're saving to buy a house in just 2 years, you cannot risk a crash. You need those brakes. Your portfolio will be mostly bonds. Ultimately, no successful driver uses just the accelerator or just the brakes. The key is to use a strategic mix of both, and that mix is what we call a portfolio. We'll break that down in our next deeper dive.